Hi there, welcome back. With the business model stress test, we looked at the longer-term soundness of your business model. But what about the current financial soundness of your business model? Will you make a profit? Do your investors get a nice return on their investment? And do you have enough cash in the bank to pay your bills? In this video, we look at this type of questions, and we provide the tools to test your financial soundness. Meet Albert. He is the proud owner of a local pet shop. Unfortunately, the shop is in decline. More and more customers buy their pet products in the supermarket, and suppliers have shortened deadlines for payment. And Albert's family is reluctant to lend him the money for a much-needed makeover. They are afraid he won't get their money back. Now Albert's friend Herman has had some financial training and offers to help him. The first thing they do is look at the profitability of Albert's shop. They decide to analyze all costs and sales revenues. The costs are split into two main categories. First, the fixed costs. These are all the costs that are independent of the number of products sold. This includes loans, insurance, rent, electricity and the phone. Second, the variable costs. These costs are proportional to the number of products sold. Think of purchase costs and labor. It turns out that sales revenues are barely enough to cover those fixed costs, leaving no space for Albert to make a living out of his shop. Something needs to change. Now, when you want to know if it's financially sound to invest in a new business idea or a new product, you can make a business case. A financial business case estimates the expected revenues and costs and predicts if you will get a return on your investment. To make estimations, you need to make assumptions about costs, about prices, about the number of customers, about sales, about interest rates, etc. Investors often judge the outcome of a business case in terms of a return on investment, meaning the profit as a percentage of their investment. But there are other criteria as well involved. Think of the risk involved. Investors will only invest in high-risk businesses if they can expect a high return in case of success. Other investors will find the payback period important. The payback period is the time it takes to earn back an investment. Now, let's look again at Albert's shop. They decide that the shop needs a makeover and that the product portfolio should change to better cater for local pet owners. Herman makes a business case for the new pet shop, and they think they need about 25,000 euro in investment and that the payback time could be about 2 to 3 years. With the new shop, the business case assumes that 25% more customers will come, and each customer spends about 10% more on average. And due to his cash problems, Albert cannot afford to invest himself. He has to negotiate with the bank to see if they will lend him the 25,000 euros. Or he has to convince his family that they will get their money back. Now, there's one more thing, and that is about cash flow. You can be rich on paper and still not be able to spend a single euro. Your company may require a high working capital. For example, if many customers are late with paying your bill, or if a lot of money has gone in inventory, then you cannot spend or use that money. It is not free. And if you cannot pay your bills, this can cause you to go bankrupt. So, having enough free cash is really important, just as a profitable business is. So, let's look at what we have learned in this video. For a good understanding of your financial soundness, it's good to test your profitability by considering all your costs and your sales revenues. You may get ideas to optimize your product portfolio or make your operations more efficient. Now, free cash flow is important too. You need it to pay your bills or invest in innovation. And you want to start something new, a business case can help you to decide to invest or not. Good luck with your assignment and have fun.